Hey everybody, welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. I got some feedback from this morning's What's Hot on the Open when they saw the headline, Russell lagging, tempered outlook on the market. And so basically people were asking, well, strategically, if you have that type of outlook, what can you do to have like a fixed risk, also realizing that you might have a fixed return type of opportunity? And so I looked at the different types of strategies that could take advantage of an environment that's mixed to slightly bearish, and you want to put a fixed risk return. So taking a look at the Russell 2000 and the rut, it's down almost 0.2% or 0.14%. Down $1.87 at 1366.30. You can see that battleground that we discussed, the 20 and 50-day moving average, is now no longer acting as support. It is acting as resistance at this juncture on the rut. Now the rut is a $1,300 product, so you can take a look at the IWM. If that fits your account size a little bit better, it's 1/10 the Russell, and you can see it is down 15 cents. Basically almost similar to the RUT index. And again, below its 20 and 50-day moving average. So I thought this is a good opportunity to talk about a strategy that's called a calendar spread. And specifically because we're neutral to slightly bearish on the Russell 2000 at this juncture, if in fact that was our sentiment. And right now it's mixed at best. You could do a put calendar. Now, what is a put calendar? If we jump into the trading platform, go down to the option chains, basically what a put calendar is where you're selling a put option that has a shorter time frame to expiration than what you're buying. So you're going to be doing this typically for a debit. So I'm going to sell the same strike contract, strike price as what I'm buying. So let's put this into context. Now, I wouldn't do the weeklies because it's just not enough time. So I'm not going to look at what's expiring in 2 days. I'm not going to look at expiring next week. I'm actually going to look at the options that are expiring on April 21st. So that's about 2.5 weeks. And I'm going to look at the 135 puts. So let's say I want to sell those. Okay. So I'm going to sell those, and then I'm going to scroll down, and I'm going to look at buying the May 135 puts. Now, when I scroll up, let me just do this real quick. I want to do this real quick. Sorry, create my own. Okay. So again, I'm going in, and I'm going to be looking at the April expiration monthlies, so that's a normal expiration cycle. I'm going to sell the 135s, and I am going to be buying the May 135 puts. So as you can see here, I'm selling the options that are expiring in about 2.5 weeks. I'm going to collect $1.25, but because that would be a neutral to slightly bullish opportunity. One thing that's notable is that's a 39 delta. That's telling you right now that there is a 39% probability that this option will be in the money at expiration at this point in time. It's also telling you that it roughly has about an 80% probability of potentially touching 135. Taking a look at the 135 puts that are expiring in May, which gives you basically a month and a half. So in other words, 44 days to be right. It's giving you a 41% probability of being in the money at May expiration. And again, about an 85% probability of this level being touched between now and May expiration. So there's a high probability that the market could pull down, and that's what we're anticipating. And at this juncture right now, if you take a look at the IWM, currently right now, for the next 8 days, the options are pricing in through the end of next week a $2 move in the index. That's either up or down. And for the next 44 days, it's pricing in a range of $5.37. So it's definitely pricing in the potential for a pretty significant move in the IWM, which is trading at 136. It's looking at, basically right now about 1.5% over the next week and a half to almost 3.5% for the next 3.5% to 4% over the next 44 days. So with this being said, I could actually do this strategy. Let's say I'm going to do 2 contracts. I could probably get this done at a price of 132. So if I buy 2 contracts, you're basically putting about $264 at risk, or $132 per contract. My max profit is if at April expiration, the underlying is trading at 135, right? That would be my max profit, which is roughly around $93.60, not including commissions. And again, like I said, there is a 71% probability, 71 to 80% probability that it could potentially touch the level of 135 between now and April expiration. So if I put a 1.32 debit, review the order. And again, what am I trying to do here? I'm trying to put a fixed risk, fixed return. If the market pulls down in the Russell 2000, I could potentially profit from that pullback. If it stays flat, or in other words, it stays at this level of 135, 136, and it's actually pulling back pretty significantly, so I'm probably not going to get that 132. It basically means that I'll have these May puts on for $1.32, not the $2.50 that it's trading right now. So I'm reducing my cost basis. And then I can make a decision. Do I want to put a bear put spread on where if in fact I can sell, let's say the 132.5 puts, let's say collect another $1, that means that I only have 32 cents of risk and a 2.5 point spread. So we'll talk about the maintenance of this strategy and we'll take a look back at it. But I just, again, wanted to give you a strategic approach if you think that the market could pull back. And again, I said that the Russell 2000 is that canary in the coal mine. And it wasn't buying into the rally, and we're seeing that the market's pulling back even after an ADP number. We have mixed headlines coming out about the Fed, about rate increases, growth, things of that nature. And so anything that's revolved along those lines is going to be sensitive and could add some volatility to the domestic side of this, which is going to put the Russell 2000 on notice. And so we're seeing that action today. All right, folks, that is it right now for Strategy Now, the bear put calendar. We put that on for $1.32 as an example of how you can strategically approach a market when you have slightly bearish sentiment going into the most current expiration cycle, which is the monthly May or April options. Join us at 3:30 Eastern Time. I'm going to be back on for Tech Talk. See you then.